All right, good morning, everybody. So we got kind of a busy week. This isn't the big week that we're all looking for, um, but there's a lot going on. So we're gonna get data out of Europe this week. Kind of makes it a big deal. We have an unfolding situation in the Middle East pushing on gold, oil. Of course, that's taken speculative money out of other things like Bitcoin. We've seen on Friday a lot of speculation going into Hong Kong that somebody kind of had some inside information, I would bet. Uh, Everybody's been pointing to the YINN ETF. It's up really well. Think of the China ADRs, BABA, Baidu, JD, PDD, XPEV, NEO, that group. Japan also doing well. NASDAQ down, um, very likely from NVIDIA, but not as much as NVIDIA. And it really seems like trying to get a disconnect there. S&P basically flat with the Dow small caps up a negligible amount. So it's SAAS versus IGV and versus chips, right? So you could use SMH and IGV as a pair group. Wholesale inventories really isn't going to be any issue today. CPI Wednesday is going to be a big deal. Some more job numbers on Thursday, but not the big stuff. And it's just a week trying to hold the line, waiting on next week. We do have some auctions today at 11:30. Once we're done with those, pretty much have a clear afternoon. We just have to get through the morning session. So we're going to be getting rates from around the world. We can see they did a little bit of a Europe market wrap and listed what they think these different nations are going to do with their rates this week. Oil will move markets. I know that it's not popular nowadays since oil isn't as powerful as it was over a decade ago, but oil is still powerful and it goes into the carry trade. So you want to keep your eye on that and gold. So Thinkorswim has added some extended hours watch list columns. They're trying to fix this issue that Thinkorswim has had for years, where it just doesn't do a good job of showing what's up in the pre-market. We've always had to use like custom indicators, things like that. So just click the tiny little gear icon, hit customize, type in EXT, and you can see the three new ones: extended session last, net change, and percent change. Yeah, they're trying, right? It's still, I go to TrendSpider and TradingView and those places, they still tend to do a better job, but got it loaded this week. We'll see if it'll change anything. I wouldn't hold my breath. All right, the 21-day average daily range now is below 85. I can't remember when it's been this low. It's been a while. It's been quite a while. So this is a measure of volatility. Volatility is just a nerd word for movement. If volatility is low and it's a look back function, it means that we haven't been moving very much. Well, I mean, surprise. So we're topped out inside of, I believe that's Wednesday's range, kind of playing peekaboo out of the top, IX10. Now, when we're IX10 in a range like this and the range is wide, it's not as impactful as it would be if we were IX10 in a really tight range. IX10 is just a real fancy way of saying that we're inside day and it's lasted for more than one day. Just because we're topped out doesn't mean we're going to fall down, right? Markets need to correct, and they can correct in time or they can correct in price. And this is a correction in time. We're just going sideways and letting these moving averages get caught up to us so that we don't get too overbought and become parabolic and fall back down again. Having said that, we're not going to stay in this range forever, right? I know that that's a pretty obvious statement, but you can toil away here in the range, struggling and fighting and, you know, putting in a lot of risk, or you just wait for us to leave the range. At some point, we're going to do it. So, you know, we got OPEX, FOMC. We've got a lot of other economic events on the table. The market is waiting for something that's pretty obvious. And when we get it, we're going to go. There is a third theory that this is it, and we'll just chop within this range into the end of the year. Obviously, not this tight little range, but this bigger, wider range that we've set. But we haven't fallen. And if you take shorts now, then it's just speculation, right? We don't have a short signal. We don't have a long signal either, to be fair. And since we're basically flat this morning, when we look at the ADRs, we don't have much edge on trying to anticipate which direction we're going to go. To get to either ADR today, we would have to break outside of Friday's range, Thursday's range, and Wednesday's RTH range. You can see with Wednesday, you know, it does have a lower level from where it started and then it rallied. But if we just look at the RTH of Wednesday, then that's it, right? That's what we've got. And if we're going to get to the red line on either side of this ADR, we've got to get outside of Friday's range. Looking at the central pivot today, it's just slightly above Friday's pivot and it's inside Friday's channel. It's kind of a more neutral bias to be inside of the previous channel. It's slightly bullish since we're higher than the previous one. We can see that Friday's was higher than Thursday's, but also overlapping. So we tried to make a run for it, couldn't get it, failed and came back in. The channel is getting more narrow. So if we start with this one, see that it was the wider one, it's a little less wide, and now a little less wide. We can see the weekly channel down here really wide implies that if we did break out, it likely fails and we come back in. We are resting on a voodoo line. On SPY. On the ES 6120, it's overhead. I didn't turn on the hourly on the ES, but there's an hourly set too. I think there's an hourly voodoo line running right through the 60-80 area. I don't put a lot of weight into those voodoo lines since it's proprietary levels that have to be hand drawn and shared out by the creator. So those levels continue to surprise. Just can't put a lot of validity into them if you can't duplicate the outcome. Still above the 3-week, the 10-day. We've got the call wall just overhead and the put wall right underneath us with the volatility trigger. It's easy to overlook the idea that the put wall or the call wall, either one, it's just a function of where the levels are placed today by the computer, right? And if you read Spot Gamma's founder's note often enough, they'll talk about a false wall where the algos will pick it up and say, yeah, that's where it is. But when you dig a little deeper and you look, it's a wall that may last a day or two, and then it moves. It's not like they rolled it up to this level, and when we see it move maybe in a day or two, that they went in and rolled it back out, that it's just a temporary level for whatever reason it happens to be there, and it doesn't stick. So still waiting on Spot Gamma's AM notes. Maybe we'll get a little bit of insight. We'll take it for its word with what we see. And if we do, then we're pinched between these two levels. We got to get through it to do anything else, which it's Friday's high and low. I mean, not perfectly, but good enough. So either way it goes, if we break Friday's low, that volatility trigger, in my opinion, has more weight at this point than the put wall does. We could expand really fast to the downside, other than we've got a lot of things down there. It'd be hitting every branch on the way down. Zero gamma is so far off that by the time we got down there, it would really accelerate. And I just don't see that sort of move unless we get news or something else that could drop us down there in the first place. There's too much options structure around us right now. If we try to break out, dealers are going to be selling into it. If we try to break down, they're going to be buying into it. So it's going to take something extraordinary to get us out of this range. And we just don't have anything scheduled today big enough to do that. You can see that we're continuing last week's point of control into this week so far. And if we look at the range that we were just talking about, 60-75, 60-10, if we can get out of that to the upside, we got 60-11 cog line and then just clear skies. Otherwise, below 60-75, we can break out of the profile's value area low, deal with this lower distribution, a high volatility, high volume and node. It's the lower D. And if we break that, we've got a straight shot down into 60-18, 60-20. Yep, that's it. 10-day, 30-minute volume profile with TPO. Point of control is up here with us. We're building it out as we go. In 2.5 days, we built enough volume up here to wipe out 8 other days, including this structure down here, which, in comparison, we stayed there all week. And the volume isn't half as much as what we had up here within a few days. Other than this point of control being up here, the only other thing of note is that each new candle we're going to get on the right is going to wipe one off of the left, and it's not going to touch what we're holding now for at least a week. So there's no perceived change to where this point of control is anytime soon. As long as we stay within this zone, it'll act a bit like a magnet. We'll just continue to chop back and forth. It won't be supportive or resistance or anything like that. We're just going to crisscross it back and forth, and we wouldn't see it as support or resistance unless we leave the range and try to come back into it. So if we leave above and come back in, it could be supportive. If we drop below and try to run back up, it could be resistive. But until we leave that zone and try to retest it, it's just more likely a magnet, and we can cross back and forth through that zone. We don't have a new VPOC from Friday because we're just chopping in that zone right now. Same thing we said on Friday about Thursday. We could just really tie all these together. That's the structure that we were just looking at on the 10-day. So we got to get out of the box. Sooner or later, we will get out of the box, but the longer we're here, the more structure we build on each side of the box. We are 2.3% above the 10-week moving average. That's a really good place to be. We're slightly on the decline from around 3%, but don't let that decline fool you. Everything looks good here. We're not at risk. We're not overbought. We're not overextended. Things look just fine. And from the daily, we're about 0.5% above the 10-day. That's fine. We are starting to curl over again. You can see we haven't been spending a lot of time under the 10. Just a nice, smooth, clean, consistent range above the 10. So right now, the wave is still rolling. Everything's fine. We're not overbought. And we are maintaining a reasonable distance. So as much as we're sideways, the 10 hasn't caught up with us yet, and it's not negative to the market yet. So last week on Friday, we got this week's range, and we drew a box on the week that we had, and we laid it on top of the proposed week that we were going to get. But the week wasn't set in stone on Friday. These lines don't lock until Friday after the close. But we can see the difference between the week we had and the week we do have now. The distance between the green and the red line is developed based on implied volatility expected move. So if volatility is high, the range gets wider, and if volatility is narrow, then the range gets narrower. It's a time function also. We got short weeks, then we don't have as many days on how far we could travel versus a full week where we have more days that we could travel. Well, this week has the same amount of days as last week. So the only thing that made the box smaller this week is that there's less volatility. Now on the surface, that might make you think that there's nothing to worry about, less volatility. But big events cause the market to go into a pause mode, and volatility gets reduced because the firms, the markets, everybody's waiting on the data. And if we're all waiting and nobody's pushing the market, then we go sideways while we wait on that data. It suppresses volatility. So don't take this narrow range at face value and say, oh, well, it's a narrow range. There's not a lot of volatility. I guess there's nothing to worry about this week. Maybe. Or there could be something big enough that the range is narrow because everybody's expecting to sit sideways while we wait on this really big data. If you don't have this indicator or you don't have Think or Swim, then look at Friday's expected move range from where we're at right now. It's about $116 plus and minus, right? So take where we're at, add 58, and then take where we're at and subtract 58. That's your $116. It's not perfect. It would have been better if you had marked the levels on Friday, but it's good enough, right? There's no reason to stress on it. This is the expected move from now into Friday. If you want today's expected move, you can just get it from right there. It's $32 plus or minus. All right, Bitcoin's down 3%, but it's still up 5.7% over the last 5 days. Semiconductors are down close to 1%. They're still not in the red over a 5-day period. The Mag 7 down, TLT. And since our benchmark is 0.5%, then none of the others here count for things that are up. What's XLE energy, which is generic because there's so many things that go into energy. Gold miners, nat gas, and 2 different China ETFs, which really we could add to that. See where it put it. YINN is up 18% this morning. It's triple X China. But even without that, the KWEB constituents or MCHI, those are all 3 China. Emerging markets, that's basically China. Crude, oil and gas exploration from the Middle East issues. So if you're looking for a breakout rally day, those chips need to not be negative anymore. They don't necessarily have to rally. We already got the disconnect between NVIDIA and the NASDAQ. So we don't need chips to run. They just need to stop falling. On the other side of that, getting some financials up more. We can see XLF is up a little bit. That's not enough. We want more of that. Consumer discretionary, right? Like we need that backdrop for the rising tide. Otherwise, the only other thing that's going to move the S&P and the NASDAQ today, if we don't get chips off the ground, would be some 0-day flows if they just come in the options and run it up. We can't predict that in the pre-market. There's no tell for that, right? We would need something else. So keep your eye on gold, crude yields. They're going to be your best tell at the moment for anything that's really going to kick off. We can see US dollar Japan trying to run this breakout from Wednesday, Thursday, Friday range. It's trying it now. It's still under the 10. So, even if it can start that Thursday, Friday breakout, we got Wednesday's high, the 10 period moving average to get through. And it would be the first time in what, 2 weeks since we broke down and really dropped below it. So it's question is, are we just coming up to test the 10 before we fade away from it again? Or are we actually going to try to get that breakout and break over? VIX is still in the dirt. So even though the S&P isn't really going anywhere this morning, the VIX isn't upset about it. We're just holding those lows. The dollar is underneath the 10, resting calmly. It's been tangled with the 10 for over a week now. So above it, below it, we're just kind of cycling at this point. We need an expansion away from it. We don't have it. Got the NASDAQ testing the 3-day, and the S&P resting on the 3-day. If we break it, we can expand down to the 10-day on both of those. 21,316 and 6060 on the ES. The MOVE index, it's only updated once a day, but the last measure on that thing was an extreme move to the downside. The MOVE index is bond volatility. So here we are on the daily. And again, this is only updated once a day. So, we don't know what it looks like yet this morning, but we've had some significant moves in bond volatility through November into December, taking us down near 82. And if we zoom out, I mean, it's been a long time coming. Since 2022, we've been above this level. Back in February 2022. If you're looking for that run up in TLT or that run in bonds, I don't think we got it yet, right? And we can see this morning that gap down kind of putting us in the wrong direction. So I'm on a daily chart here on TLT. That gap up on Friday, hitting basically 95, rejected, brought us right back down inside the range again. So that half back is the level that we've got to get through. And we've left a lot of trash behind. So sure, I mean, we've got gaps to the upside that need filled, but we're leaving some behind in the other direction too. The Russell was up this morning, so small caps getting a little bit of love. Uh, the small caps are trash though, so if you want to look at something that is maybe a little bit better, you can look at IJR. It's the S&P. It's like they're trying to pick the cream of the crop. Or this US Cash Cows 100. There's actually another one, CALF. There's your small cap. These would at least be, you know, better small caps than just something really generic like IWM. So 13% of the S&P is up 0.5%. PayPal, Tesla, Oracle. Otherwise, we got some trade desks, some manufacturing, energy. Nothing really exciting in there. Not what we need to see if we're going to get that rally. And if you look at what's down in the S&P, 0.5%, chips, Qualcomm, AMD, NVIDIA. So that needs to change if we're going to get that rally. And again, they don't need to run, right? They just need to stop falling. Look at the NASDAQ names that are up 0.5%. Is that software again? MDB, FTNT, WDay, a little bit of retail, some consumer PayPal, Tesla. And SMCI. Always got to have one, right? Looking at names in the NASDAQ that are down, 11% of the NASDAQ down 0.5% or more. Surprising to see some tech names in here. Datadog, AppLovin, Applied Materials. There's the chips, MU, NVIDIA, ARM, AMD, Qualcomm. So there's your chips. If you take the top 10 names in IGV and the top 10 names in SMH, this would be the list. Kind of break it out over the last 5 days. What's been doing good, what hasn't been doing good. And it's not as clean as it was. It's more of a mixed bag compared to what we have been seeing. So maybe we're going to get that transition finally out of chips and service. So miners still look pretty rough. Silver's looking a lot better. We've already started that breakout. It needs to keep the breakout now that we've got it, right? Above that, call it 70, 28.75. We've got it. We need to keep it. Pot stock's got a big push, but that's one single bar. We want more out of it than that. So we'll have to revisit on pot stocks. Emerging markets, you know, it's basically China anyways. Crude. We're even getting some agriculture this morning. So we all want that rising tide lifting all the other boats until all the other boats rise, and then we're not seeing the indexes move. All right, that's a big move in industrials this morning, but it's just one print. I want to get a little more out of that. It needs to hold this structure though, so 138. That's a big gap. Yeah, that pretty much sums it up. Bonds, solar, Bitcoin, chips down. We got to get that to change or we're not going to get any rally. We're not going to see the market really go anywhere. And with everything else carrying the load, I wouldn't expect the S&P and the NASDAQ to crash or to even fall hard. I just wouldn't expect them to rally either. So it's going to take some news to get us out of that box that we're in. Play the edges if we can even get to them. Look for the difference between a sideways day and a range day. If it's a range day, you'll have opportunities to trade the edges, really decent reversals. If it's a sideways day, it's just going to be trash. You have to narrow down the time frame that you're trading. Really try to pick up the flows using the dome and time and sales, that sort of stuff, right? Really step up your game a little bit. Otherwise, just go after gold or something. Crude's moving, so maybe take that route. So I got for you guys, be careful, be safe, watch the clock. We got auctions today. I'll see y'all tomorrow.